Okay, Indian markets have resumed trading. At least the pre-open session is on after the trading halt triggered by the lower circuit on the Sensex. 7969 is where we are trading right now, 7971. So we are not tanking further from where the levels that we shut shop. In fact, the Sensex is doing a tad bit better. Remember, that was the index that hit the lower circuit. But these are pre-open rates. These rates will change. And I think the material rates or the rates which start off when we start off trading at 1057 could well be very different. Now, let's get in a few voices to make sense of this mayhem, as we like to call it right now. Chakri Lokapriya, Managing Director at TCG Asset Management, joins on the show. Chakri, this is unraveling fast. March 13 was the first lower circuit. We recovered from there. Doesn't seem like we'll recover from this one because it looks like we'll start off another, I mean, at almost the same levels. What would your thoughts be on this?
Good morning. The pace at which things are unraveling, I think the market clearly is trying to figure out a bottom, which is still a distance away. If you just look back at history and if you look at the global financial crisis, the markets had assumed an earnings cut well in excess of 25%. If you do a rough math, basically current earnings cut, because when this whole corona thing started, was roughly about 15-20%. Now, if you just go by strict math, that implies that there is further downside to the market from current levels too. Now, as things unravel and various production of companies like OEMs have suspended production, hotels, etc., the whole services industry has come to a grinding halt. So there is going to be significant amount of income erosion which the market is struggling to price in. And against in those circumstances, markets usually assume the worst and go lower.
Chakri, good morning. The sentiment is totally fearful at this point. So maybe even the early signs of a bounce back or a recovery may not be bought into completely. Do you feel then that could extend this recovery to a slightly longer period of time as and when we form that base?
I think, we would have a number of trading bounces up and down for the next coming several sessions. And each of them should not be perceived as, the market has found a bottom or the market is trying to move on its way up. Because, the commentary that will come out from various sectors is likely going to be negative. When it's negative, so there's going to be a further readjustment to the new reality. Against that backdrop, I think the pure retail buyers are better off sitting by the sidelines. Institutional funds will nibble in readjusting their portfolios. And traders, it depends upon whether they're taking a positional call or a day-to-day trading. So I think retail investors, in my opinion, should stay away for quite a bit longer.
All right. What's your own strategy, Chakri? What are you adopting right now?
We have raised a fairly decent level of cash. We are north of 25% plus in cash. And we do not see it being deployed anytime in the soon. What we're looking for is some amount of a stability of the virus outbreak numbers-wise, outside India. That is important, not within India. Now, that will be the first indication. And second is, concrete government proposals, policy actions are important at this point in time. For instance, BS4 vehicles, if March 31st is the deadline after which registration is not possible, we need to have an announcement from the government, from the courts, that's saying that, yes, we are going to extend it by 3 months, 6 months, whatever that is. I think those are the tangible steps that we will look for before we deploy funds.
So far, we've seen a lot of push behind a monetary stimulus. Do you feel that, and from the rest of the globe is what I'm saying, India still has refrained from taking any kind of interest rates cuts at this point at least, but the RBI has indicated that they're watching the situation and they'll take an action as and when required. But is monetary stimulus enough, or there has to be something that comes in the form of a fiscal package?
If we just look back, look at other countries currently what they're doing. Now, U.S. has announced tax cuts for its employees. Of course, it's a policy decision that's unfolding. A $1 trillion rescue package. South Korea has provided rent subsidies and tax breaks. Japan has provided low-cost loans for companies. A number of different countries have taken actual steps. And I think what the Indian market needs is such concrete actions from the various government bodies for specific industries. And this is more so important, and they should be policy actions which address the immediate need of a freeze in the economy, a freeze not of liquidity, a freeze of movement of goods. People are not going to a bike showroom to buy a bike today. People are not going to a restaurant or a hotel. So what do you do to address that situation? So those are the policy actions which are needed rather than long-term policy actions.
Yeah, by the way, the pre-open rates have settled down and we should try and pull up what's happening. So I don't think there is any material change from what happened the last time. So we're still down about 9%, quite unlike the experience on March 13th. There is hardly any recovery. The currency is not recovered. The US future should come up on your screen in a moment because remember the last time when we were shut for 45 minutes, the US futures had recovered. For now, the Dow futures are not showing any kind of an uptick either. So that continues to remain under pressure. The pain points don't seem to be ending. Quite unlike that Magic Friday, Devina, today could be different.
Yeah, could be different. And the second half of the day could be that much more volatile. For the India wicks as well, we've started to pick up. I think we've crossed 70 on the India wick. 70.85 is where we are at. So it's not that big an increase that we're seeing. It's still not the highs of this current correction that we had seen before in the last few days, but back above 70, so 71 for India wicks. Chakri, just talk a little bit more about the defensive space. At such times, where do you hide? Do you hide in pharma? Do you hide in IT?
I think that's a relative call in terms of the falls are clearly have been across board and will continue to be across board. In a relative world, IT and pharma, I think the earnings are far more protected versus the other sectors. And yes, those clearly would be sectors. And traditionally consumer staples maybe to an extent, but again, the valuations are fairly rich over there. So these are all relative trades. And also, mind you, India is majority, a 70% plus services-dominated economy. So when services come to, there are curbs put on services, and that impacts the whole economy.
Yeah, I think that's a clear and present danger, and gauging the economic impact might just be a very difficult thing right now. IPCA and Cadila are probably the two names which are in the green, but aside of that, it's futile to talk about the green on the Nifty 200 as well. All the remaining 198 stocks are either trading in the red or trading absolutely flat. That tells you volumes about the kind of pain here. Chakri, just wondering, would you, I'm guessing the answer right now is to stay away, but would consumption be the first port of call as and when this turns around, or is it even futile to talk about turning around right now because we frankly don't know how long this will last?
Yes, consumption, both, consumer discretionary, because consumption as in consumer staples haven't fallen as much as the overall market. So consumer discretionary, clearly yes, as and when this settles down. And all indications are that, the Western markets, Western real economies are talking about a 2 to 3 month time frame before things stabilize. So if that's any indication to go by, looks like that time frame one needs to wait before, one can go back into the market.
Yeah, it does. Okay, Chakri, just one last question from mine. This massive fall that we're seeing in the financials, we're not getting into the merits of whether it's warranted or no. Let's assume everything is warranted right now. Does it bake in the worst? The last time, I know the book values get adjusted downwards for sure and NPAs pick up, but the last time I saw Bajaj Finance trade at, 3 times price to book 1 year forward was many eons ago.
Yes, indeed. I think, the valuations for the whole financial services sector has come down quite dramatically just in the last 1 month or so. So from a pure valuation perspective, are they attractive? The answer is clearly yes. But I guess now what the market is waiting to reprice is what will be the loan rates, what will be the growth rates for the next couple of years post-corona once the dust settles down. And a lot of what the growth rate will be dependent partly on company actions and more so on what policy measures the government comes up with in the coming weeks and days.
All right, and we are, we've heard that Prime Minister Modi is going to be sitting down with industry bodies to figure out the kind of impact that they will be seeing due to coronavirus. Chakri, thanks very much for being with us and sharing your thoughts with us on the platform. We're just under 2 minutes to go for market open once again this morning. At pre-open, you got the Nifty at 7,933. Remember, now your next circuit falls at about 15% cut for the Nifty 50. So that's, and the Sensex both. So that's a level to keep in mind. We'll get you those levels once the market starts to open as a live update. HUL at pre-open is closed with cuts of 5%, and that's your top gainer on the index amongst the better performing stocks. And the worst one is ONGC, which is giving you a cut of about 16%. Oil and gas is a pocket, along with banks, has looked extremely weak today. So be it Reliance, BPCL, IOC, all of them, and ONGC too, are down and out in the session.
I just want to mark a couple of things. By the way, I think ICMR is saying that a total of 415 people have tested positive for coronavirus as of 10 a.m. And I think states have been asked to strictly enforce the lockdown. There is legal action against violators. This is as of today, which is 23rd of March 2020.
All right, so guys, please take this seriously. I mean, only for essentials should one leave their houses, because now we are starting to get a strong reinforcement coming in. Police on loudspeakers requesting people to stay indoors and not venture out. That's Nifty Bank opening on your screens, 11.5% lower. I think Nifty 50 is also at 7,960. So that's a 9% cut. So not a material change. Sensex is 9.5% lower as well. Just above 27,000 for the Sensex. A lot of stocks, have actually there's no change needed. It's just a matter of just stopping trade and restarting trade at price levels that were just the same 45 minutes ago. So there's no incremental damage. There's no incremental positivity as well. So it's just about there. Mahantesh Sabarad of SBI Cap Securities is also joining us right now on the phone line. Mahantesh, great to have you with us. What have you made this total capitulation that we've been seeing in the indices?
Good morning, Devina. I think you said it right. It's getting all the more difficult to really predict what's going to happen in the market ahead, simply because we don't know the extent of economic damage that is going to be caused by the various lockdowns and shutdowns that we have been witnessing so far. Markets are intertwined with the underlying economy, and so it's getting a little difficult to predict where the markets are headed right now.
Good morning, Neeraj here. It's anything but a good morning. I understand that. What's the advice that you've been giving to your sets of clients? I mean, for example, for people who had money, hide it under the cushion or start deploying?
So the first level of advice that we are giving to our clients, Neeraj, is that they stay away from market volatility, stay away from risk. And while it is better to stay in cash right now and rather than deploy, because we really don't know where the markets are headed, like I said before. So the first and foremost task is that from a safety point of view, we don't want participants to take undue risk, because the moment you enter the market, there is an element of risk that's happening. Even your downside protection are getting broken at successive trades or successive days. So I don't think we would go all out to advise cash is the way to remain safe in the market, and there's no need to deploy in a hurry right now.
By the way, I must say, just want to mark prices. Axis Bank is now down 22%. So it's actually worsened. It was down 19.99, 20%. It's now 22.5% for Axis Bank, 23% as we speak. M&M Financial down on the 20%. You name a financial name, Ujjivan Financial, IndusInd Bank. IndusInd Bank at 359 with a assumption that the book doesn't change too much is trading at half price to book. Obviously, these books will change. The book values will change. NPS for most financials could change. But just keep these numbers at the back of your mind. The numbers probably don't mean anything right now. Mahantesh, financials were the first port of call. Everybody disbelieves that the new bull cycle, whenever it starts, has a new set of leaders. People believe financials would be it. Would you reckon that there could be changes in all of these? The bank nifty is down 15% as we speak, because now there's a double trouble, right? One, you do not know how the book shifts over the course of the next 2 or 3 quarters, and the asset quality and the provisioning that some of these might have to do, the moratoriums that some might have to give, might just be something that we haven't seen in the last 10 years.
Yes, you're right. I think the book that we currently see, or what has been declared by the banks in the latest financial numbers, is not going to be the book that we will start out with in the new fiscal year. And moreover, there is the question mark in terms of additional capital raising. That's the point that you didn't really mention. When books get eroded because there is a huge amount of provisioning that you take, the only leeway available for a bank to survive is raise capital and raise substantial capital. And that's where some of the banks and some of the financial institutions are weak at the outset. I think the weakest would potentially be the private sector names, because they are promoterless, right? From that perspective, at least from the PSU point of view, you have a large promoter sitting in the form of the government supporting all of them. So from the future's point of view, I really don't think the financials will really lead the way for the next rally that we might potentially see ahead, simply because capital is of concern. It's only those institutions which will be in a position to raise capital are the ones who will survive and lead the rally.
In light of that, then, Mahantesh, all these bigger ones, bigger names within the financial space that have suddenly seen this, flux, this total withdrawal of money, should technically be the ones that you should consider to invest some, even if it's a small amount at these levels, or just completely wait it out before you take any investment call, be it even in the large caps, be it in the mid caps or the small caps.
So one of the thought processes, Devina, we have is that irrespective of how large or small the financial institution is, that we haven't seen redemption pressures come in so far. Redemption pressures either from the domestic institutions or from the financial institutions located abroad who invest in India through the FPI route. I suspect a lot of redemptions are likely to happen in the course of time. I recall the 2008 phenomenon, where we had the markets crashing earlier in January. There was a semblance of recovery right until, and that market stayed put virtually until May, after which the commodities collapsed, and gradually the redemption pressures were so great that by the time we reached October, the markets was half the levels of January peak. So what I'm essentially saying is that we haven't seen the redemption pressures come in so far, either from the domestic institutions or from the FPIs. And when that comes in, we will generally have a lackluster market gradually drifting down. So therefore, wouldn't urge investors to take a call or a bet right now. It's better to wait it out.
Mahantesh, is the fundamental call that we might head lower from where we are right now? We are near circa 8,000. You reckon we'll head lower?
Potentially, yes, because the economic damage is going to be quite terrible. And earnings, we haven't seen the earnings downgrades as yet. The earnings downgrades could be closer to 20-25%. When you have fears expressed for an U.S. economy, for example, going down by 5% in terms of GDP growth, then that delta change can cause potentially 20-25% drop in earnings for some of the companies. So I think we haven't seen the downgrade there. So an 8,000 today, the Nifty, let's say at 8,000 today, may appear to be trading closer to like 12.5 or 13 levels. When the earnings downgrades do happen, you actually will find for that the markets was actually trading at 16 or 17 multiples, which by itself is not cheap.
It's quite interesting because when markets were at about 12,000, there were talks that while the index is at 12,000, there are stocks within the broader market space which are trading at levels of 8.5, 9,000. Now at 8,000 market levels, you wonder what those stocks and the intrinsic value for those stocks would be. So Mahantesh, technically speaking, if you were to factor this in, 2 years of no mid-cap performance, completely wiping out 2017 bull run in the mid-caps. So right now, why is there no conversation about looking at mid-caps?
So I think what is potentially not known about mid-caps is the sustainability of the earnings. Many of the mid-caps also face problems with respect to promoters' ability to fund the businesses. Many of the promoters in the mid-cap companies themselves are leveraged or over-leveraged at times. And that is slowly going to unravel as we go forward, as defaults grow. So there will be a situation where a lot of businesses will either close down or potentially refer themselves to the bankruptcy court. I think that's yet to play out. We haven't seen referrals to bankruptcy coming in as yet. And I think that's one thing that we have to watch out for. Mid-caps most of the mid-caps will be headed towards the bankruptcy court when the economic damage that is being done right now becomes very deep.
Hopefully we find a cure well and truly in time before that. But yeah, some of these things.
But that's interesting because in our earlier conversations also, there were talks of whether or not these bankruptcy cases should be put on hold right now, at least in these tumultuous times, and most likely.
Well, you never know. Let's see. Let's wait for the government to come out and say what they want to do. But Mahantesh, the point is well taken. Thank you so much for joining in today and giving us your perspective.
Thank you.
Well, 13.5% for the Nifty Bank, 10% lower for the other benchmark indices.
We're lucky don't hit circuit because of Nifty Bank.
No, I think the circuits will probably happen if these two hit 5% apiece. But the key is what happens in the event of banks dragging the benchmark indices much lower, because right now those seem to be the clear pain points. It's a wrap on this leg, of course, of the show that we wanted to bring about because the markets kick-started trading yet again. We'll keep on giving you updates on our Twitter handle and on our website. Do log in and try and read more about the markets. Thanks so much for tuning in.
According to a recent report, women today contribute nearly 74% of real estate buying decisions. This includes 30